Hey, what's going on with you, buddy? All right, let me check my audio. Let's see. Audio settings. I am, but not very well, so I was just turning it up a little bit. Um, I have I have this meeting that I do every day, and the person on the other end is really loud, so I turned my Zoom settings down so they don't blow my ear out. I adjusted it now, so should be better. Oh yeah, yeah, no, that's good. I just had it turned down too low. So, did you resolve that tasty trade issue? Yeah, that would be really frustrating. I remember I had my first experience with a really big vertical was when Google and Amazon were thousands of dollars of stock, and you could put on like a $10 wide uh, vertical on there, and they were massive. You know, I had one that was an out of the money short short call or short put. I don't remember which one, but it was out of the money. The ones that I jump up and down now and say I'd never trade. Back then, I didn't know any better. Some far out of the money piece of trash. And I ended up having one that was losing. And if it's $10 wide, in theory, it can't lose more than 10. And the P&L was like showing me minus 14, minus 16. I'm like, what the heck is going on? Because, it doesn't, it's not based on your actual trade. It's using the bid and the ask. And so those out of the money options, if it's a illiquid product, they can have some crazy numbers attached to it, and that'll show you a nasty P&L that isn't true. When I was new, that Google trade, or maybe it was Amazon, it was one of those two. That scared the hell out of me that whole day. For those that missed it today, in the chat this morning, I posted a thread. So go back to when me and Kevin were talking this morning about the NASDAQ. I believe that's where I put it. And right here. So all of those dealer hedging flows like Spot Gamma, Volland, Mentor Q, they all use this OPRA feed. And if you want to know more about that, just click the thread here. I talked to AI about it so that she would kind of give some depth on what it is and then how those various platforms are using it. And the levels, of course, shift through the day. What I post in the morning with those lines, or these combo levels and all that, that's the big picture static level, and it's what a lot of people use. It doesn't cost you anything to look at my picture there, and then you can mark the lines, and all's well and good. But for those who have access to the platform, you can monitor those levels in real time and see them being adjusted and built someplace else, like what Marziti shows here in the picture that he shared in the Discord chat. Let me get it brought up. Now this is from Unusual Whales, but it's the same logic. Here's the strikes on the side, and you can see the gamma exposure per strike in there. and they will act a bit like a magnet. Now, most of these sites will have an explanation somewhere. They'll have like an FAQ or a public service document that will explain these levels in a lot greater detail. And that stuff is free. You don't have to buy that level of education. They want you to use their tool, right? So if they teach you what their tool is doing for free, you'll be more inclined to use their tool. It makes sense, right? That they just want your money. So of course they're going to explain what it is. There was a question in the chat by Hugo. I was waiting for him to show up. He had a good question about today's market. Is he in here yet? No, not in here yet. At least I don't think he is. The market has bottomed out for the day. Now, we of course we can go lower, right? Markets can do whatever the hell they want, but for the most part, we've pretty much stopped falling. We can see that this pullback and the next leg lower, and then this pullback and the next leg lower, but it didn't go lower. It stalled out there. And then we had this smaller pullback and a very small move lower, right? It's very small. And then we broke that pullback with a higher level here, right? So technically we got like a higher high there. And oh, Hugo, okay, you are here. So this is why I said that I think we're done, right? Now, we could get a headline or something else, and that can send us lower, but it's turning around, right? And these are some of the signals that told me that. The fact that we didn't just do this and instead we did this, and then we barely, just barely got a lower wick there. That was one thing. Then when we breached this level and put up that higher high. So, they're giving it a try right now. They're trying to turn it around, but even they don't know if they're going to succeed, right? But they're giving it a good shot. But statistically, we don't run one direction all day. So all day long, we should be asking the question, are we done going higher or are we done going lower, whatever direction we have been going? And that's another thing that I constantly do is ask that question. Are we there yet? Are we done yet? Are we there yet? Are we done yet? And look for any signals that say, yeah, I think we're done. Here's our Globex range, and you can see that that put us into the 111 of Globex. And then we tried it again, and we still wasn't able to get through that 111 of Globex. And we've got this trend line breakover. The problem is we've still got to get through that 786, right? And then, of course, we just take all of that off and use the lowest point to the highest point so that we can see our real mid. And there's our 786 breakover. The fact that we fell back down underneath that 786, I'm not really excited about, but we got to see how this level plays out. What I'm looking for after getting this lower low here, which isn't good, that's a bad thing. We want a higher low here. This might be our higher low. We don't know. Need to see how price responds because it could just, do that for all we know. My little chicken scratches. So hopefully that answers your question, Hugo. Yeah. It's good that you have targets and you have a theory because that's what we have to have, right? But constantly look for validation and for anything that can break it. Like I usually phrase things like my base case and then my alternate theory. That's usually how I play it out. My base case is what I'm planning for, and then if my plans go to hell, then I've got my backup. Because usually, the market's pretty binary. If I thought I was going to get A and I'm wrong, then plan B should work. Yeah. You are right. There's a lot of things to be concerned with right now. And this short term drive to the upside does not mean that we should not still be concerned with all those gaps. There's a lot of things that can tell us there's something wrong. Really big bars, lots of crazy wicks, and gaps. Those three things can be subtle to newer traders, but once you see them, you can't unsee them. And I think that's what's happening with you. You're seeing them, and now you just can't unsee them. And it's a good thing, not a bad thing. So embrace it. It is a warning and a red flag, and it's gnawing on you, and you can tell that there's something wrong. Absolutely embrace your spider senses there, because you got it. Those are some of the tells that something just ain't right. And of course, we don't have to go back down. We could claim this high and just keep right on going, but it's very likely that we're not going to do that. And those China ADRs too, they move all. The control key will allow you to pan. So if I hold control, see, watch up here, these menus. When I hold control, it gives me a way up there. It shows what I'm holding. So I hold control and I can move this up and down. And then if I let go of control, so yep, with control. If you run the wheel without control, it just runs you left and right. But if you hold control and then run your wheel, it holds the chart still and it only goes to the left. Yeah. It's a red flag. And Marziti, you hit it. We're in a low volume environment. Even the S&P right now is low volume, and that's why it's acting like a low volume stock, like you just described. Yep. Well, we're waiting on a lot of things. Right now, the war is the biggest thing that the market's waiting on, and more confirmation that this war is bringing in inflation. We all know that it is, but they want actual hard numbers because a lot of the funds and firms, they don't get to make assumptions. They have pre-written rules, and they're called non-discretionary traders. When the rules say inflation is blah blah blah, they have to buy, they have to sell, and that's what they're waiting on. They're waiting on more confirmation that the war isn't done and that inflation is going to whatever number it's going to. The rest is just anecdotal. No, you're spot on. Those are the warning signs that are hard to articulate with newer traders. They just don't get it. But you're moving past that, right? You're moving into the matrix. Uh, it's worth noting that when it comes to the futures like the ES, the NASDAQ, um, a lot of the participants that are in there, they're not you and me, right? They're not speculating. They don't care if it goes up or down. They're not getting in now thinking they're going to run it up X amount of points and get out. They're trying to make payroll. They're trying to hedge their lean hog trade. They're trying to do something that has nothing to do with the price of the ES going higher or lower. They don't even focus on that. Now, I'm not saying that every large institution is doing that, but a lot of the contracts that are being traded on a day to day basis have no bearing whatsoever on, I think it's going to go up from here, or I think it's going to go down from here. They're just trying to make payroll, or it's even less connected than that. And it's some person who got the call and their boss said, hey, I need you to pick up 9,000 contracts today. And they're going to sit there throughout the afternoon picking up those contracts until they've got 9,000. Or they're going to let go of 9,000 contracts until they get it done. Like that's their task. They come back from lunch, they get the email and it says, hey, unload 9,000 contracts today. Okay. They don't even know why. Is it for payroll? Is it because we're hedging something? Who knows? The boss says I need to unload 9,000 contracts. I'm unloading 9,000 contracts. That's it. You have to keep that in mind when you see price move. They're not out to get you. They might not even have a plan. They don't even care if the market goes up or down. They're just trying to get filled. That's it. And you might be thinking, why don't they just hit the button and close all 9,000? Because they don't want to have to explain to the trade commission why they crashed the market or spiked it up 400 points, right? They can't just go in and buy a boatload of it like that or sell a boatload of it without getting in trouble. In theory, technically, there's no law against it. They could do it. But if you start getting that sort of market manipulation, it will get out of control. And there's going to be investigations and all sorts of problems from it. So they're not going to do that. They're going to work it and they're going to try to get it filled. And I'm sure there's some in-house metrics or criteria that they have on getting those fills with a proper bid ask or within a percentage of a certain level, way outside of our wheelhouse, right? Because we don't trade that way. We're not interested in just getting fills. We're worried about where it's headed and how much we can make along the way. But just keep in mind that trading as you know it is from your retail trader's point of view, which is we are speculating on where price is going. And so much of the order flow that's happening around us couldn't care less. A lot of it also, if you start focusing on SPY, the Qs, that sort of order flow also is what we call non-discretionary. They don't get to choose. They think the market is going up. They think the market is going down. Who cares? They don't get to choose based on what they think. If the VIX drops below a certain level, they have to go in and buy. If the VIX rises above a certain level, they have to go in and sell. And it doesn't matter what they think. So again, that's a lot of order flow directly not connected to any sort of speculation of where they think price is going. It's called forced buying or forced selling, and they don't get a say in the matter. So really keep that in mind. As for what's happening in the broader market, it looks great. And there's been chatter from the institutions that, you know, we could signal the all clear and we could continue to rise up out of that. Of course, we could, but there's a lot of problems with this ceasefire. And there's still all the ships that are now stuck in that canal. You know, it's going to take over a year to clean out the ships that are there just because of how slow they move. That if the strait opened up today and they all started to move, it's going to take a year for those ships to get out of there. Some of them are carrying things that won't even be here in a year, right? Like those hydrogen or the helium ships, their product is toast. So it won't even survive. So there's a lot of problems coming at us, including inflation and the backlog of those straits and all the damaged facilities that have been hit that are now offline that it's going to take years to recover. Our crude output is now lower than it was during COVID. because of all these damages. Inflation's coming. Global recession is coming, and there's nothing that they can do about it. So, is the market likely to go higher from here? Good news and bad news, right? If bad news is now good news because it's going to cause them to raise rates or give us rate cuts when they start cutting rates like crazy, then yeah, the market's going to price in those rate cuts and we're going to go up. Yay! But if they're only raising rates because the world's on fire, then eventually that's going to bite us in the bum and we're going to go back down again. Yeah, right? There's a silver lining in there somewhere. I'm sure there is. Yep. I worked on drilling rigs for a long time, and during rig moves, we would get on the boats, and they had people hired on that boat. All they did is run needle guns all day long, chipping away at the rusted points, right, and repriming and rebuilding the ship literally while we were on it all the time, right? Because it's just falling apart. You can't have something out there that isn't constantly being worked on. And the longer it sits there doing nothing, the worse it is. Halliburton and what is it, Schlumberger or one of those guys, the ones that rebuild, yeah, the ones that rebuild those facilities when they get damaged, those companies should do good because there's a lot of work that's going to need to be fixed. So, could we go up from here? Yeah, but for how much longer, right? And that the other day we were talking about Taiwan semiconductors and how it's a little bit of a leading indicator about 11 months or 12 months. And I went hunting for those articles after the stream. And let me get my notes here. I grabbed the links for two of them. Of course, we don't want to read the whole thing, right? I don't want to sit here and read you guys and put you to sleep. But there was two that really stood out. One was written in December 2023, and it's really kind of an explanation one. It's called "The Power of Silicon Island: One Indicator to See the Future of Semiconductors." And in this, it talks about Taiwan's leading and lagging indicators, the Export Order Trends Index, the Real Semiconductor Equipment Import Value, and the Stock Index. Then it has the lagging indicator, manufacturing inventory values, unemployment rate, interbank overnight call loan rate, and a couple other components. And so it uses these and it did a look back of what happened in the past. And then they start using that going forward from there. So this was what got my attention when I first started using it and learning about it was back when this article was published back in December 2023. And then the one that I was trying to find the other day to talk to you guys about was the one that came in December of 2025, right at the end of the year when we had just gotten through or we were getting ready for another earnings cycle. And Taiwan Semiconductors had like a really amazing blowout earnings. And the article basically was the fact that they're going to have to maintain that level of input, especially since they spent a lot of the money they made to expand their facility. And I had wrote in the Discord a lot that connected to this too. If you was to go back to December 2025 in the Discord, you would find my write-ups that I had posted and how Taiwan Semiconductors was going to be splitting their business up and one of their competitors was no longer going to be a competitor because they were going to take a different route. And like a lot of things was changing between December and March. Well, we're past March, right? So we're getting ready for Taiwan Semiconductors. And of course, we're going to do earnings and all of the semiconductor plays. And the leading indicator right now is showing some really negative signs, right? That's what I showed the other day with that big turn to the downside right here. This is the one. Oh, look at that. It turned back around. The other day, though, that thing was pointed straight down and it didn't look good, not even a little bit. So maybe they're going to turn things around a little bit. Maybe not. We had the same kind of whiplash back here, big steep move up, and then it went back down, then it went back up, and then it finally started trending lower. Maybe this is just the shenanigans right now, and we haven't got it solved yet. But remember also, even if we are getting the signal, it takes 11 to 12 months before we start to see it finalize. Still, it highlights that we've got some serious global recession risks coming at us. They could avoid it. It is absolutely possible that we don't end up in a global recession, but I don't see how at this point. I'm hoping to learn something along the way that maybe explains how, but I haven't found it. I'm open to any ideas if somebody, could point something out that maybe suggests why we wouldn't have a global recession in about a year from now or sooner. Oh, when it comes to the administration, and I try not to get politics too much into my streams, but politics are a part of trading at this point. We have to acknowledge that. This current administration has stated multiple times that chaos is their weapon and they plan on using it. They are deliberately creating chaos through comments made to the press, news articles, everything that they can do to deliberately cause chaos. They are doing it and they want to do it. That it's a part of their strategy. All right. And that is straight from them. They have stated it multiple times. If you ask your favorite AI about it, I'm sure it could probably find the quotes from um, either the president himself or a couple of members of his cabinet. So yeah, the chaos is on purpose. Yeah, yeah, I could see him doing that absolutely. I don't doubt it, but it does continue to highlight that this rally up in the market is not sustainable. I am not turning my portfolio long, and that I mean I can't tell you guys what to do with your money, but with my portfolio, I have not turned it to go long. There's nothing wrong with, taking some cheap lotto plays if you can keep the risk really low. Why not? They make good hedges if we happen to get some sort of rally to the upside, just make sure that those trades are very cheap so that if they don't work, you don't even care. You just shrug and like whatever. And if they do work, well then great. You had some really cheap option, make you some money. This kind of goes to the heart of something I was talking to somebody with the other day, and they're kind of new to swing trading and they're kind of upset. And I get it. It's a difficult time to try to be a swing trader right now. It's not to say that you can't do it at all, but you're handicapped. You're severely handicapped if you're trying to swing trade in the current market environment because we don't have a lot of the normal common denominators that we normally would have. And new traders don't even grasp that because they don't know what normal looks like, right? If you just got here, how do you know what normal looks like? You wouldn't. So they're at a severe disadvantage. But there's a lot of books and a lot of history behind these comments that we're not in a normal environment. We're in a high risk environment. Trades will lose more frequently because of these market conditions. And so if you don't want to lose as often, don't attempt those kind of trades right now because you're trading in a high risk environment. Certainly a good time to take alternative trade style tactics and or shorter duration trades. The earnings to earnings trades they're not working right now, right? Normally we'd run like quarterly trades from one earnings cycle to the next, and those are just broken. There's no theme, there's no consistency, no follow through, and that just breaks the whole system. Investors Business Daily, which runs William O'Neill's style of trading, they are a company that focuses on stocks that are doing good, that are healthy, good stocks to begin with, right? They don't focus on like low float penny stock trash and then point out, oh hey, look, this stock is breaking out. We should go long. The stuff that they tend to focus on has really good fundamentals, and then they track it for price signals that meets their qualifications for a trade. The funny thing is when we're in a bad market environment, these high risk, negative condition market environments, they'll flat out tell you, okay, here's a signal. We're getting a breakout in this, but your chances of it actually working really low. Right. And I mean, that's their flagship model. That's their premier trade. And they'll still tell you probably isn't going to work, even though it's a textbook setup on a really good name with strong fundamentals. It probably isn't going to work. You know what I mean? Like, what do you do with that? If even the biggest traders out there don't even want it, these guys got massive amounts of data. If you haven't used them before, by the way, they have a lot of free trials. Take your time with those trials and just do one at a time. And if it's not free, it might cost you like $14, right? Hey, it's worth it just to give it a try. But do one at a time and take your time and go through their education. Once you're on their radar, they'll send you emails like once a year telling you when things are free or when they're really cheap. I used to sign up for those and then I would grab all of their education when the door was open. that's that's what I used to do. I would grab all of it that I could grab and stuff it into my own private little Discord, and then I'd separate it later and clean it all up and learn from it. So, long trades that you can still take though, um, kind of reflect on the sectors or the industries or big institutional stuff like oil, right? Oil is way expensive and oil is sticky right now. It's going to stay elevated for a considerable amount of time, but it will go down eventually. So if you're looking for a longer term swing trade, that would be a longer term swing trade. It would be a short in crude. This is a monthly chart. We're looking all the way back to 2007. and you can see that we're near highs that we don't have higher levels than that, right? It's this 140, what is that? 147 and a half, 147 and a quarter. So we're not there, right? But we got near it, and if you're looking for a long-term short trade, shorting crude is like going long gold, right? Or going along SPY. It's a longer term trade that will usually play out if you're already at elevated levels. You don't have to use CL, by the way. There's micro, or there's something like USO. Use an ETF. No reason to tie up a lot of your capital in a swing trade in crude that could blow up before it paid you. So this is USO all the way back to 2007. You can see that we're not near the high there. It's why I didn't start with that chart to begin with. But look at the range that we've been in for the last 3 years or so. This is 2002. We got a big breakout of that zone, and shoot, this thing could, it could double from here for all I know. Um, no cap on this, but you could trade RBOB or you could trade CL for a swing. You know, in fact, let's see what the options look like on crude. Maybe micro crude. All right, there's no trading on the shaded out area yet. We'd have to wait another week. We have 6 days left on the current contract, and volume is light. Let's see, we could say sell a call, $422 is our max profit in that. It has a buying power of $4,500. If that buying power is a bit much, then you could do a call vertical. But now our max profit is $11. So, we kind of want to adjust that a little bit. I'd rather have the new contract to trade, honestly, but 450 for this one. It's too close to expiration, and I don't like that I can't roll out right now. If this was to be challenged, you have nowhere to go because you can't roll into any of these. They're all still grayed out. So probably MCL right now would be a bad idea, but CL is still out there. And well, no, can't go any farther out. Never mind. Not really good for the short call. Can't go out far enough. Need the new contract to come in. We could take a look at copper. Nothing. Gold. There we go. See how gold's got a lot of opportunities. 46 days worth. By the end of next week, we should see what that looks like in crude. Which reminds me, they're going to have issues that we're going to get into a backwardation in crude if they're not careful. We might already be doing that. Let's see. Backwardation. Yeah, there's a volatility term called contango and backwardation. So in a typical time versus price metric, things usually run like that. Things close to us, like 1 day out, 1 week out, they're kind of cheap. And the farther you go out in time, like 30 days, 60 days, 90 days, they get more expensive, right? Because you got the possibility of hurricanes, drought, war, famine. So many things could happen in the future. And that goes for interest rates, options, shipping deliveries, right? So many things. They just get more expensive the farther you go out in time. That normal curve that I just drew there, that's called contango, and that just means everything's normal, and that as you go farther out in time, things are going to get more expensive. Contango. But for crude, we don't normally live in a contango state in crude. Normally, it's more of a backwardation state, right? So if you look at crude right now, it's high in the front, and the farther out we get, the cheaper it gets. That's backwardation. If we were looking at equities, or not equities, if we were looking at VIX, this backwardation would be really bad. But for crude, this backwardation is more normal. It's decent. But the problem is we got 11 days on the front contract and 39 days on the next contract, and they may start to roll early just because they need to get this situation resolved before crude spikes up again. Say weekend risk, for an example. What if they start rolling early, like this week, today, or this afternoon? If they did that, they could start pricing up that next contract out. And so the curve wouldn't go the way it is. Instead, the curve might start to go the other way. Or, maybe it would have a bit of a dip there. The thing, the thing about the are you still shook from that trade? The thing about the ES that, or the futures, that a lot of people misunderstand is that it is the forward outlook of the broader market. So if you look at the ES, where are they projecting the S&P to be at by the time we get to September? Higher than where we are now or lower than where we are now, and by how much? Well, if you look at where we actually are, we're at 68.54, and they think that we'll be at 69.07. It's about 50-point spread, and that is absolutely normal. That's what we've seen for like a year at least. So that number is not out of line. But if we start to get some really negative situation going on out there, these two numbers will begin to tighten up. And if you begin to see uh, contango in this, oh boy, that's really going to get out of control, right? So, or if you start to see backwardation in this, I got it backwards again. See, we're farther out in time, the number gets higher and higher and higher, and that's what it should do. That is this normal curve, contango, and that's what we have here. But if things get really bad and really negative, the forward outlook of the market will turn around, and we'll start to get that other shape, backwardation. And we don't have that, but it's a leading tell, right? This isn't math like a floor pivot, it's just math. This isn't a moving average or somebody looking at the Farmer's Almanac. This is real money being traded in the market that moves these values, and it's for a date and time that isn't here yet. So it's literally a forward looking indicator, completely different than something like a moving average, which is looking behind us and asking, hey, what happened in the past? This is asking, hey, what are you expecting in the future? Well, that's good to know that that's how it can get cleaned up. It's a good tip. No, by all means, go for it. I was getting ready to draw out kind of what was going on here, although I shouldn't even draw it out. I mean, you got the pictures, but you guys know what a butterfly looks like, right? Right? You got the body and then the wings. You sell the body, you buy the wings. And I'm not using the real strikes. We can just keep this hypothetical. If this is the butterfly, then this is what was sold, and these are what is bought, right? So you got two short, one long, and that's a butterfly. But what if you're looking at this and you're like, I'm going to add a short vertical in there too? Well, you would sell a put and then you would buy a put that's cheaper somewhere else. So if you sell this one and you buy that one, what's it doing? It's going to wipe out one of your legs in your butterfly. So
I am building a double diagonal on Thinkorswim. I already built it on Tasty and it's in the chat. The strikes that I'm using. The I'm just putting the right strikes in place right now. Okay, this is what I built on Tasty. The reason I came over to Thinkorswim is Tasty does not do very good when it comes to the risk graph and the hypothetical position that you're building, right? So when it's a solid position like an iron condor, a vertical, it's not too bad, but diagonals are a fixed rate trade. This adjusts. You know, like with a vertical, if you build it and the vertical says that it's $5 wide and you can't lose more than $5, a diagonal might start $5 wide and lose $6. It can expand and contract. Your max loss can expand and contract. And brokers can really struggle to highlight that. Tasty really struggles to highlight that. So I came over here because what I was worried about is this center area here. I want to put on a double diagonal that has a bottom side and an upside in SPY. And as long as we stay anywhere in the middle of that, I'll make some form of money. Sounds like an iron condor, right? It is a lot like an iron condor, except the wings are so much farther apart and there's still money in it. If you make an iron condor too wide, you just don't get any credit, right? Maybe you get 5 cents in a $2 wide trade and there's just no money there. But this trade has that saggy spot in the middle, and I've got to negotiate that problem. So on Tasty, the strikes that I used are built here. I'm going to double check my numbers, make sure I got the right one. It looks like it. Let's see. Copy the trade, bring it back over here, post it. I used 665 short put. Yes. I used 695 short call. Yes. And then 664 long put, check, and 696 long call. Yes. Okay. So I built it right. I've got the dates correct. Yes, the 17th and the 20th. So this is the same one. I went I went $15 out because I was looking at the Monday April 20th as my $15 out. But because of that sag in the middle, I'm thinking I'm going to bring it in some. And as long as I'm somewhere around $12, maybe even $10, then we can probably get rid of that sag. And I should still have a wide enough wing to not get run over. Right. So, and we're at 680 basically, right? 679 and some change. Let's just call it 680. If I go out of the money 10 points, then I'm at 690 instead of 695 and 696. So I like that. Let's try 690, see if we can get rid of that sag. And then on the other end, if we're at 680 and we go out of the money 10, then we'd be at 670 for the puts. We need 670 short and 669 long.
And what does that give us? We have to pay a little bit more, but it should give us, there we go, a double diagonal with the middle not below the 0 line. To me, that's really important. Now we want to change the date on this calendar up here so that it matches our Monday expiring position. And we can see that my break-even lines are inside the gray area. Not good. Let's back it up to that Friday, the 17th. Yeah, we're a little closer, but I'm still inside. This is how far it's projected that we could go. And this is where my trade break evens. So in theory, we'd want to move that out just a little bit. But if we don't think we're going to be making big moves either way, then we could leave it inside. Now you might be wondering, what's the loss of this trade? Because diagonals, they can be a little squirrely when it comes to trying to figure out your max profit and your max loss. The max loss to the downside is 170. Max loss to the upside is 155. If we land on the lower sweet spot, it'll make about 250. And if we land on the upper sweet spot, it'll make about 180. It's going to cost me $70 to put on. And we have a really wide profit range. All we got to do is land somewhere inside of these two hills and we'll make money. That's all we have to do is land somewhere inside of these. Now, the problem with this trade is it's a time-based trade. We are already between the lines, right? We don't even have to go anywhere. We wake up Monday morning, we're already, hopefully, still inside the lines. So the only way that this trade will see profit is when time goes by. I'm going to move time now using this wheel down here, which, by the way, you can do all of these things on Tasty, but it doesn't show you visually as well as it does here. And in my opinion, it's more complicated, but you can do it there. I've been doing it here for so long and it looks better. So I'm going to be here. So now that I've clicked that wheel, we can adjust the volatility, we can adjust the stock price, and using this lower calendar, we can go forward in time, like Back to the Future kind of stuff, right? This calendar is how you change what the dynamics are for your implied volatility range and your calculations of implied vol. That's what this calendar up here is for. It's for the trade that you built. This calendar is for you to look forward in time. So we want to move forward in time to Monday. That should be Monday the 13th. Yep. And we can see that my profit line, which is this yellow line, has started to rise. As long as price doesn't actually go anywhere, all I have to do is sit here day after day and the trade will make more money along the way. We just hang out and let it go. I won't start to take loss unless we get outside these bands or the edges there. So time goes by, the trade continues to take the shape of this cyan colored line. And by the time we get to expiration, that's what the trade will look like. Here's one day before it expires, right? And you can see how it's starting to take that shape with a curve here and a little bit of a curve there and not much of one here. But that's as close as we can get because the next day is the day of expiration. And at the end of that day, the yellow line would look like the cyan line. They're literally on top of each other. So that just, there's nothing left to show at that point. But that's a double diagonal. You guys can find a video on this on the Bullish Bears. It's called the Marcus trade. There's another trade that uses this same logic, and it's a flyagonal. I don't know if you guys have heard that one before. This one is very much like a iron condor, right? It's very much like an iron condor. A flyagonal is more like a butterfly, but it uses the diagonal logic so that you have different expiring options, just like this has an iron condor with different expiring options. So let's build a flyagonal. We'll start with choosing, do we want a put version or a call version? And let's just build it right where we are going into the close for a, you know what? Whoa. Hold on. Before we get to the diagonal, where's our weekly expected move? And did the double diagonal that I already built, did it stay within the lines for next week's range? It's a good question. This is next week's range. We've got 691 and 668. Move this line down here just for easy viewing. That line up there, 663. I'm way below 668. That's awesome, right? If I was using an iron condor and I tried to build the iron condor at 665, I wouldn't have any money in that thing at all. I'm able to put my break even at 663. That's awesome. Let's put those lines on the chart so we can see them in relation to the expected move. Yeah, awesome. Detach this, spread it out here. Show me what you got, Joey. These two lines are where our lines are for our double diagonal. So if SPY breaks the weekly expected move next week, no problem. It just needs to close inside of these two dotted lines, and we will have some form of profit. So that's the double diagonal. Now let's look at a flyagonal, and I'm thinking we build it right on the middle line and see if it's big enough to cover both edges. I don't know if it is or not. That's why I figured we'd try it out. We're going to build it at 680, right? And now the question is, which one do we want to use, the call side or the put side? If volatility goes down, that's going to hurt the calls. It shouldn't hurt the puts. Well, if we're long the puts or the call, if we're long the options, the volatility going down is going to hurt us. So that ain't going to matter. I guess it won't matter. Let's just do the ones that are the least expensive. And right now, because of skew, puts are cheaper than calls. So we will sell 2 of those 680 puts, and we will buy 679 and 681. You see what we did there? We sold the 680 and we bought 81 and we bought 79. That's a butterfly, yeah? The only difference is we used 2 different expirations. So it's a diagonal and it's a butterfly. So it's a flyagonal. I didn't make this up, by the way. Somebody else much smarter than me. No, I didn't. I wish I could have taken credit for it, but I can't. Not mine. Look at that. It is covering the edges of the expected move model for a 1 standard deviation probability. Now, that's not the same as the weekly expected move, but it does cover the 1 week range, which is pretty cool. I'm going to change these slices that we already put out there so that they don't get removed. If we don't rename them and then I send new lines out there, they're going to delete those. So we need to rename them. This way I can put new lines out there and they won't get deleted. Wrong one. Need the other set. That's the ones we want. Okay, now those are inside the weekly expected move. So that flyagonal that we built right on Friday's level is not big enough to cover the entire range by itself. But that's okay because we have 2 diagonals on in the first trade, right? We built one on the put side, one on the call side. So why not build 2 flyagonals? And we could build 1 flyagonal on the green line and 1 flyagonal on the red line. Makes sense to me. We'll just delete those lines. We don't need those anymore. And I'm just changing the line type here so that they stand out a wee bit. So as we were talking about earlier, there's always ways to trade, right? In a high vol environment, low vol environment, war, chaos, COVID, doesn't matter what it is. There's something that you can do. And as long as you have control of your risk and you understand the metrics that are in play, why not? Right? Like some cheap out of the money call, for an example. If it's 2 pennies, you can't get coffee nowadays for $2, right? You might as well buy a call for $2. Maybe that $2 will make you $100. So this flyagonal, we're going to move it. We will go out. I used what, $10 on that other one. We'll go out $10 on this one too. So we're going to use 670 for the options that we sold. And that means 671 and 669. All right. That is our put side flyagonal. Let's delete that other one. And then we'll do the same thing again on the call side. So from 680, we'll go to 690. I need a few more strikes. A few more strikes. We're going to sell the 690 and we will buy. I'm in the wrong expiry here. Sell 2 of those and buy a 91 and an 89. There's our call side flyagonal. Notice it looks a lot like our double diagonal. The difference is it's much, much wider. The break even is even farther out. So if you're worried about getting run over because of war headlines moving SPY, an extra large amount, well, this has got you covered because it's got much wider break evens and it has more money on the profit, right? It's about $400 on the call side and 500 on the put side for max profit, which you should never anticipate ever getting a max profit in a diagonal or a double diagonal, right? Just like with a butterfly, you should never expect max profit. We do have this little saggy zone in the middle. As I mentioned before, I don't like that. I personally would rather get rid of it. That's just me. But since this range is so big, why wouldn't you want to get rid of it, right? You're going to have to compromise on the range a little bit, but I say, so what? It's worth the compromise. So out of, yeah, right? Like, let's put these lines out there just because I'm curious about how far away from that weekly expected move we are. And then we're going to move the lines. But I just wanted to visualize how far out are those lines. All right, these ones in the middle, we don't need. They're just confusing everybody. You can see that it added, wow, $1.20 to the upside and about $1.30 to the $1.40 to the downside. So it increased our distance that price could move. Not bad, huh? To be fair, you can still lose in a trade like this. It is absolutely possible because you can never get far enough away from price. If we get some really wild headlines or something like that, oh, you can get run over. The thing is, you've got so many strikes that you can convert this trade into something else if you did get some really radical price action going down, right? We'll talk about adjustments in a minute. First, we got to get rid of that saggy area in the middle. So let's do that. And of course, once we do compromise, we're going to have a narrower range. and it's very likely it'll be the same as the double diagonals range, although still probably with more profit. So let's get rid of this. It looks like we have more room to the downside than we do to the upside, but I'm pretty centered, right? It looks like a fairly delta neutral position at this point. Feels like it, anyways. Let's see if we can get rid of that line. Which one is that? Delete slice. Yep. And delete slice. Oh, that was the wrong one. All right, it's okay. We'll just steal this one. All right, there's a 49.29 to the downside and 48.93 to the upside. It's so minuscule, right? I'd say we just walk each side one strike. That's fair. That way we don't compromise too much on one side or the other. So we sold the 690. We want to instead sell a 691. And that means we need to, oh, wait, I went farther out on the call side. We want to do a 689. So we need this to be a 90 and we need this to be an 88. All right, the call side has been moved and price went up another $7. And now on the puts, we sold the 670. So we want to do a 671. And that means we need to buy a 672 and a 670. And the cost went up, oh, $4. That's not bad. It's cheaper to move the puts than it was the calls. And hey, we got rid of that saggy spot in the middle. We're no longer going below the zero line. Now, it's not as wide as it was, but that's okay. We got rid of that negative position in the middle. Nobody wants a negative Nancy. All right, wow. On the top side, it is right on it, and the bottom. Okay. This double flyagonal landed exactly on the line of the other one. So the P&L, the cost to put on the flyagonal would be $2.55 to buy that flyagonal, right? Because you got to buy the call one and then you have to buy the put one. That's two separate transactions. It is a combination of 8 contracts and a lot of commissions, a lot of slippage. They will be difficult to fill. Even just one of these would be difficult to fill, but having it doubled, it's going to be hard to do. On the other hand, the double diagonal that we had built is 70 cents. Now, really? Did I lose you? You're my bellwether, so if I lost you, I know I lost them. The idea of a diagonal, if we just back up a little bit, get everybody on the same page, is that we want to use multiple expirations, right? If I sell that 680 and I buy this 680, I have what they call a calendar. And the only thing that changed is the date. I bought a 680 in one date and I sold a 680 in another date. So it's only a calendar because we didn't move anywhere. We didn't move up the chain or down the chain. We bought and sold the same strike. But if I had bought a 680 and I sold a 679, well, now I actually moved up and down the options chain. And if I do that in different dates, then it's called a diagonal. because I moved up and down and diagonally through time, right? So that's where it gets its name from. So let's just buy that 681 and sell this 680, and there's our diagonal, right? We would call it a vertical if I just did them in the same expiration. I'm just moving vertically here. But because of time, we moved diagonally. So a double diagonal is putting the same trade on, but using the call side and the put side. I started options in August of 2018, and by December, I was trading them full time. It didn't mean that I knew it all. The nice thing about options is how many varieties of a trade that you can take. Going sideways is an excellent trade style for options that you just don't have with futures or regular price action, stocks, that sort of thing. You can trade non-directionally and get paid because price didn't move at all. And that's awesome. But you can also just literally trade probabilities. And yeah, The thing about the paper trades that you want to remember though, and since you're already a trader, you'll understand this, but new traders miss this completely, is that the bid ask isn't real and you'll feel like almost immediately. In the real world, that is not how it works. Here's paper trading on Thinkorswim, and I just logged into paper real quick. I got SPY up. I can just come in here and say, confirm and send. It's very likely just going to fill that, right? Like, boom, done. Um, in the real world, you'd have to haggle that bid ask spread. And SPY is one of the most liquid products out there. And so, even in the real world, you'll feel pretty good on that. But this was one leg in a very liquid thing. If you add two legs, say I want to buy that one and sell this one, now I've got two bid ask spreads. And again, it's SPY. It's one of the most liquid products. It will fill, especially in paper, it'll fill. But in the real world, I'd be fighting both of those bid ask spreads and it'll be a more difficult thing to get done. And in paper, like he was saying, it's going to happen so fast, right? Like just being done. Wow, that was nice. But in the real world, it's not. And the more illiquid it is, the more you'll struggle with those diagonals that I was showing. That was 6 or 8 contracts, 2 different trades, because in options, you can only have 4 legs at most. And we had 8 legs there. So that was 2 different trades. It's just inconceivable that you'll get an easy fill on all of that, right? You'd have to fight it, work the order, be willing to give some up. And then the brokers never show these trades well. People think that options price move because the stock price moves. And that's only partially true, right? Your car doesn't move just because it has a motor. It needs tires and gas and oil and oxygen and spark plugs. It needs all of that stuff or your car ain't going anywhere. And that's options. The options price does not move because the stock moved. Now, the key no, market order fills well, yes, it's still true. If you market order the same time 50 other people market order, whoever market ordered it first is going to get filled first. But there is one thing to remember. Retail gets in front of institutions. That's one good thing that we have going for us. If we are standing in line at 318 and the institution is also standing in line at 318, they will fill us before they fill them supposedly. And if that works for you, great. If it works against you, too bad. That that's kind of how they see it, and it won't always be beneficial to be filled first. But sometimes it's one, and sometimes it's the other. That's what the law says. If you can prove that you're not being filled before the institutions, which I don't know how you could, but if you could, then you can sue them for it. But by law, they're supposed to fill us before they fill them, in theory. Now, the thing here's the really cool thing about options. The way that if you think about how you think about options. So I got SPY up, I got the daily chart. I can put on a trade that says, I bet we don't go any higher than that, or excuse me, that we don't close any higher than that by the 4th of July. I can put on a trade that just like that. As long as we don't close on the 4th of July higher than that line, I'm going to make money. Well, it sounds like a pretty good plan, right? Like that's the kind of trade that you can do in options. You can just choose a level like that and say, that's it. I'm going to make a trade that says that. You don't have to pick a direction. How about 630? Do you think SPY could close lower than 630 by the end of April? And if you say, no, that seems unrealistic. I don't think SPY can close below 630 by the end of April. Good. You want to make money because you can put on a trade that says, I bet we don't close below 630 by the end of April. And when you think about options from the way that I'm doing this, they seem to make pretty good sense, right? That logic seems pretty simple to me. I think it's an easy way to trade compared to assuming we know where price is actually going to go when you buy a call and say, I think SPY's going to 690. Why? Momentum and trend and fundamentals and the Ouija board and somebody whispered in my ear, I think it's going to go to 690 by the end of April. Okay, you can trade that. That's harder to do. Yeah, in the next 5 minutes. Oh, hey, we have 15 minutes before the market closes, and I could make $25,000 on a credit spread between now and the close on the SPX. That's all you got to do. Could. Now you'd have to risk 50,000 to do it. Here's a trade that would make $1,600 by the end of the day. Well, $1,555, and it's risking about $1,500 too. I built one so that it was risk half, make half, right? So what's the risk here? Max profit 1,500, max loss 1,450. Not bad, right? That's almost a 1-to-1 trade right there, and I can still make this trade by the end of the day. Options are awesome. the main thing is when it comes to options is you can think of the scenario and then ask, how do I build an options trade to do that? So any price action you want to trade, you can trade it. All you have to do is know the trade that it goes with it. The sideways trade, the long trade, the short trade, long and short, but not sideways, sideways and long, sideways and short. You can combine them any way you want. I mean, that's pretty cool, right? In the chat, these are the ones that are on YouTube. We took afternoons right here in the live streams, and I ran a class for like 2 months. And it was like a Wednesday class. So every Wednesday we would come in and I was writing a PDF that went with it. We would cover that chapter for that day. And there's like 20 videos, maybe 18 videos, but this was my version of the introduction to options. Because I went through the Bullish Bears when I got hired. They said, hey, we need an advanced options guy to make advanced options videos. And I said, okay, but what about your intro? Because, no offense to Creed and all those guys, they didn't do a good job with the introduction stuff. And they said, no, 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 we got that covered. You just do the advanced stuff. Okay. So I made the next level library. And the number one feedback I've gotten from so many people is, dude, I don't understand a damn thing you're saying. Why? Well, because I didn't do the intro. I only did the advanced stuff. So if you go into the questions tab and just kind of roll back a little bit, I shared that PDF document right here, Introduction to Options. Now it needs a rewrite to be fair, but that document goes with those videos and you can follow it chapter by chapter and have the SIG style introduction to options right there. We we covered UOA and the history of options really coming into the to what they are now, and a lot of really good stuff in there. There's of course never enough. I mean, there's just so many things to trading. Couldn't cover them all, but I think working through that would get people really lined up to be better prepared to be an options trader. Yep. The thing is, you take someone like I'm a nerd, right? I can't help myself. If I find something that I don't know connected to trading, I'm gravitated to it. Like, oh, what are you doing over there? I don't know what that is. What is that? And I learn another thing. I keep thinking I'm gonna hit this plateau to where I don't necessarily know it all, but I know enough that I stop hunting, and I haven't reached that point yet. I would love to, because this is a really good way to day trade options. It is my preferred way to day trade options because you can see the dome, right? The active trader. And when I place an order here, I can see it on the chart, at least if it was the same product. Let me put this on SPY. My order, there it is. So if I wanted to a call loaded here, 679 SPY call, and if I want to buy that call at a certain SPY price, say at the low of day, then I could move that up until I get to the low of day. Well, let's go the other way. That would be down here. Not quite there. Let's go a little lower. Maybe $3. Not even enough yet. A little lower. I'll know exactly what the cost of that option is. Okay, there we go. I'm at the low of day. If I wanted to buy a call at the low of day, I just set it up. Now, to be fair, we talked already that options prices don't exactly move when the stock price does. So that won't necessarily hold as SPY continues to fall, but it'll be pretty darn close. That way I know I'm going to get filled when price gets down here or near there, and that's where I'm going to be getting my trade. That's a really good way to do business because if I was already in and I wanted out at 680, I could keep moving my exit. Let me get that call off of here. I could keep moving my exit until I found the exit value that I want. That's not it, right? That's not it. I want to get out at this peak because maybe I'm worried SPY is going to run up and hit that level and fall back down. I can keep moving my, there it is. Now my exit is based on that point of the chart so that if I was concerned, so yeah, we will absolutely go into that last week. I'll show you how I set it up and then how you can adjust it and use it. And we'll put on some examples and yep. Right. So here's the option that I'm trading. There's that call option right there. Yep. Sure can. Yep. We'll add that to the list because it won't take us the whole day to go through the active trader and all that. And I'm also going to recommend a video. Lucian made Thinkorswim active trader videos that talks about how to make the bracket orders and the OCO orders. He made those videos and they're on our public YouTube. If you watch those in advance, you'll be more familiar with how the active trader works so that on Wednesday, when I come in, we can go right to how to start working the options side of the active trader. And we won't have to spend more time on the dome if you're already good from Lucian's videos. They're on our YouTube. So you'll want to use the keywords on YouTube. You want to use Bullish Bears, Active Trader, Thinkorswim, combine something like that, and you'll see Lucian's face because he's actually the one that taught me the beginning of how to use the Active Trader. When I was still learning Thinkorswim, I wanted to use the dome and I needed a video. I watched his. Now I used it he got me started, and then I just went from there, but it's a good place to start. He did a really good job with his videos. People ask me all the time why I still use Thinkorswim, and even though I don't trade here, it is a very powerful platform, and I haven't found anything else that I could replace it with. Because if I could find something better, I would go, right? There's I'm not married to this thing. I will happily go somewhere else. I just haven't found anything better. See, my hope is that this year TradingView is gonna really explode on the options side of things, and if they do, that might finally be the thing that breaks Thinkorswim. When it comes to analyzing an options position with the risk graph, right? When I go into that analyze tab, there's not very many places out there that can perform a risk graph and allow you the manipulation that you see me do all the time, jumping through time and space, changing volatility and increasing the price of the stock and asking what if. Not a lot of places out there can demonstrate what that trade's going to continue to look like. And I use this risk graph a lot. So until I can find something that offers me that sort of flexibility, I don't have anywhere else to go. I think TradingView has this capacity, and when they finally get their data issues worked out to where they're mass like a fire hose of data, I think we're going to start getting it. Of course, the price of TradingView is very likely going to go up because they're going to have to pay those engineers a lot of money to get this done. But yeah, it's going to be so exciting. And Lucian did a really good job on those videos. I was talking to somebody a while back, and they were not traders, but they had seen Lucian's videos, and they came in and like, "Where's Lucian? He's not streaming. I was gonna watch a live stream with him." And like, no, he's not a trader. But he does run these brokers, right? So his videos on how to run these platforms, they're really good. He's patient and calm and he might go on a tangent and be funny for a little bit, but I think he does an excellent job with the videos. He doesn't now. He tried to trade for a while when him and his two friends started the Bullish Bears. There was three of them, and they were a team, and they and they fed off of each other and learned from each other and traded as a team. But when it all went to hell, it went to hell. And maybe that's why you shouldn't do business with your friends and family. But he doesn't trade anymore. Nope, he's an administrator now. He just keeps the lights on. It's how I started. Yeah, absolutely. That and there's personality, right? Some people are timid, there's timid trades. Some people are aggressive, there's aggressive trades. There's every kind of trading out there, and you can get trades that match your personality 100%. You can match your account, you can match your risk, your behavior, your personality, whatever it is, you can form fit trading to you. And that is what new traders really struggle with because they just want someone to tell me what to do. we had a we had a guy we had a guy in the chat ask a question about the why behind the options trade. Now, this is a massive ask, so I saved it for the end because there's a little bit of a cheat that I have here. One, for this guy, his name is DC. So, starting at 4:10, I can tell him where to start the video at. This is the Bullish Bears website. It's the next level training library. And in these intro videos, I took the time to explain the why, right? Why would you use the debit spread versus the vertical spread versus the iron condor for every one of these trades? So if you're trying to figure out why, that's a really good place to start. Now, I noticed from the color of his name tag in the Discord that he might not have access to the next level library. So there's the next piece of the why. When it comes to options trades, generally speaking, if I wanted to trade a vertical, I can sell a vertical or I can buy a vertical. So I can buy a call vertical for a bullish trade. I can sell a put vertical for a bullish trade. Why one versus why the other? If implied volatility is really high, you're better off selling options. So I would rather sell puts to get bullish. If implied volatility is really low, then options are cheap. Why sell them if they're cheap? I'd rather buy a call vertical to get bullish than sell a put vertical to get bullish, right? So the why behind the verticals is implied volatility. Sell it if it's expensive, buy it if it's cheap. For iron condors, why? Why would we use an iron condor? It's because price is in a range. If price is in a range, it's not going to be a breakout trade. It's not a trend trade. It's not a momentum trade. It's a trade where price isn't going anywhere. So let's make money on price not going anywhere. And that's why we would put on an iron condor. Stipulations, of course, would be if I can sell it for enough money to make it worth my risk. We want to sell iron condors. Always, always. We don't buy iron condors. So if we're ever going to sell an iron condor, we need to know that there's enough credit in it to make it worth our while. So when you're shopping around for iron condors, if volatility is cheap, no iron condors. They're not worth the money. You're taking all the risk and you're not getting any reward. So you would sell iron condors in a sideways market and a high IV environment. If you don't have those two conditions, you don't have the conditions for an iron condor. Choose another trade, right? Then we got the PMCC. If you haven't seen that acronym before, that's a poor man's covered call. What are you covering it with? Uh, Generally, you're covering it with another option or stock. As for the concrete examples, I'm pretty sure I have built them, but if not, you could always just ask individually, like, hey, what about an iron condor? Because in the videos, I certainly show how to build them, right? Like what strikes to use, why you're building it, how much money you should be expecting for it. I covered all of that in the videos. Can I say that I applied it to a specific stock at the time of the video? Ah, man, I think I made them videos a decade ago, so I can't say for sure that they were on examples of a sideways market, for an example, for an iron condor. But um, if you watch those videos and you still have questions, by all means, please bring them and we'll find examples, find ways to demonstrate them until the light turns on and you get your aha moment. So the poor man's covered call has got to be a poor man's covered call or covered put, right? It's a covered option. The reason the poor man part says we're not even going to have the stock. We're only going to have the option. That means we've got a long option far out in time. I'll just use January because it's a typical example. I'm bullish on SPY, but not right now. But I'm bullish on SPY, but not right now. So I'm going to buy a call very far out in time. Well, that sucker's expensive. $5,240 for that call. Come on, man. I don't want to take all that risk. What can I do? I can sell options in the front end to cover it. This would be a poor man's covered call. All I want to do is sell options in the front end, sell calls, and I'm covered by my long call way out here in time. And that's what allows me to sell that naked call in the front end. That's a poor man's covered call. A lot of people use that, especially in market environments where we are sideways and going down, because you could have been selling covered calls through all of this and then through all of this all the way down. So for the last 6 months or so, you could have been running covered calls. Now we're on our way back up. So not the time to be running covered calls. But covered calls, a poor man's version of a covered call just means you're selling calls in the front end, and it is covered by a long call that you own farther out in time. And people generally do that when they're bullish on a market that isn't bullish right now, and they want help paying for that call. So when would we put those on? When we're bullish a stock that isn't bullish right now, like SPY. We can sell those calls against it and pay off that long call that we own. Imagine if I had bought a call way back here, if I bought a call for a year and a half out, right? And I bought the 700 strike. Well, since then, we went down some, we came back up, but we didn't really get anywhere, and we went down a lot more. And my 700 call is just bleeding, right? I'm bleeding time, I'm bleeding money. But if I'm selling covered calls on this, then I'm reducing my risk. If I bought that call and it was $5,000, and then I sell a call for $200, and I sell another one for $100, and then I sell another one for $100, and then another one for $300. I'm taking that money off of that $5,000 that I owe on that long call, and I'm paying it off a little bit at a time. Every one of those that I close profitably on the short side reduces my overall risk for that long call that I'm holding. We would do that on a stock that is not bullish. So for the why, on a stock that you expect to be bullish in the future, but isn't bullish right now. Because if you sell covered calls on something that is bullish, you know what it's going to do? It's going to run you over. And then it's going to force you to close that as a loser or roll it up and then roll it up and then roll it up and roll it up. And it's going to just keep chasing you higher and higher and higher and higher and higher. So don't sell covered calls on a bullish stock. Sell them on things that are sideways or going down and cover that short call with a long call farther out in time. That's when you would do them. I know I ran through that really fast, but the why behind those trades are covered in those videos. And individually, we can go through them in much greater detail. But remember, when options are expensive, that's when you want to sell them. Either you're selling iron condors or verticals, but you sell options when they're expensive, you buy them when they're cheap. You can buy an option and be bullish the market. You can buy an option to be bearish the market. On the sell side, you can sell and be bearish. You can sell and be bullish. So you just choose. I'm bullish, but IV's high. I guess I'm bullish and I'm selling something. I'm bullish and IV is low. I guess I'm bullish and I'm buying something. As simplistic as that sounds, that's the way the options theory works. And that's what you want to lean into if you're not doing it my way. And I'll leave it with that because, it's Friday afternoon, it's kind of late. My way takes all of that volatility stuff, throws it in the garbage and says you can sell options whenever you want to, and or you can buy them whenever you want to, because I know how to break the system where you don't need IV to be high to get good credit. My way is so much better. Any questions? That was fast, I know. One of these days, I'm probably going to end up on Tasty. Well, that was always the idea, but Tasty's not Tom now, so maybe I never will. But I always wanted to talk to Tom Sosnoff about my approach because I really think that my way is better. Even as a general market logic, the general market logic says out of the money options are the preferred way to go. Even Tasty teaches that. While at the same time, Tasty says it's nearly impossible to meet their qualifications to get their ideal trade, and that no institution or large scale trader has ever, ever managed to pull it off, ever. So, how can that be the preferred way if nobody can scale up and pull it off? It does. They made a lot of money on YouTube over the years. Maybe that was the goal all along. But selling out of the money options as a business model does not work. They've proven it. So if that is, to be taken as fact that you can't scale up into it and run it as a default system, then got to change the system, which is and that works. You can do that. The system that you're describing, it does work. If you individually, randomly choose occasionally from time to time to put on one of those trades. What Tasty Trades is talking about is income premium sellers who can develop a system and systematically, automatically, every day, every week, every month, whatever, sell options at a predetermined strike at a predetermined date and time in the forward future time period and be consistently successful and scale that up in size. Those guys that say, I'm going to go 30, 20 delta out of the money, 45 days to expiration, and I'm going to run it like that for the next 10 years. That crap don't work. I remember that. You got a boatload of credit, didn't you? A Jeremy style trade. This guy in the chat has another question too. I want to catch him before we're done. It's about the wheel trade. Now, reading what he posted tells me he got his wheel trade information wrong somewhere because he's trying to avoid losing over 50%. So, to answer the question about the wheel trade, one, you don't defend the trade when it's losing. You take assignment because it's the wheel. I pulled up Joby just to have something that isn't SPY, and it's kind of a cheap stock, and I know people are wheeling this. So let's say I like Joby and I'm going to run the wheel on Joby for some reason. But remember, you're supposed to be using IV. You want to run the wheel on something that actually has money, and if you're selling options the way you're supposed to in a wheel, then you need something that has implied volatility. So we'll say that this is high IV. It's not great, but it's okay. So this has enough IV. I'm going to sell puts on this until I finally get assigned stock. So I'm going to sell the 8 strike put. I sell the $8 put. I sell it. I sell it. I sell it. And we'll say that I was selling it back here when we were flat and sideways, and I was making money, making money, making money. Boom. It dropped down. It closed below $8. I get assigned. Now, what happened in this scenario? It broke my strike. I'm losing. This is not when you defend the trade. You don't cut that at 50% loss and move on. No, you leave that strike there. You take assignment of the stock, and now you have 100 shares at $8 a share. But you've been selling these puts all along. So for every one of those puts you sold that you closed in profit, add all that profit up and subtract it from your share value. If you took the stock at $8, but you made $1.50 in premium from all that options trading, then your average per share price is $6.50, because 650 plus $1.50 is $8. So now I actually own that stock at $6.50 a share. Now I'm going to start selling calls against it. I could start selling those calls at $8 if I want to, even though I took assignment at 8. I could sell them at 8 because in theory I really own them at 650, and I'll still make money on that because I'll make money from the call that I sold. And if I lose my shares at $8, I made $150 from the stock, and I made money from the credit I sold in the call. If that call gets run over, as it would have here, you can see price went up. It ran my call over. Don't defend that call at 50%. Don't close it as a loser. Don't try to roll it. Let it go. What's going to happen? They're going to take your stock. Fine, let them take it. You was assigned at 8. You gave it back to them at 8, but you made the money on the credit of the call that you sold, and you made all that money on the put side before you was ever assigned. So from reading the question alone, why are you defending a trade that is never supposed to be defended? And the only thing I can think of, trying to offer the benefit of the doubt here, is what if it's the very first put I sold and I haven't yet made any money, and I get challenged and assigned on the very first put I sold? I sold an $8 and I got assigned at $8. I can at least, at the bare minimum, take the credit that I got from the put that I did sell and subtract it from my $8. Let's say I made 10 cents. Fine. I own the stock at $7.90 and I was assigned at $8. That $10 is still there and you have the shares. So now you can start selling options on the call side, preferably higher than $8, because you got to make some money somewhere along the way. And if that call got challenged, you still wouldn't try to defend it, because you can't pony up that kind of loss in a trade system of this kind. You let the stock go, give it to them, let them have it. Either you sold an $8 call or an $8.50 call, something like that. If you're so underwater, say you're assigned at 8 and the stock is all the way down here at 6, now you're in a bind, right? Now you've got problems and you can't be selling options in this situation. You've got to wait until you've got a better situation, and or you close this entire trade out, because if we were running a covered call way up here and we got assigned, or say we're running the puts first and we got assigned, and then we tried to run the calls and now it's all the way down here and we've got options from all the way up here, it's not coming back. You're bag holding a completely broken trade. It's all gone to hell, and you need to close the entire thing out. wash it all out as a loss, start over from the beginning, it's broken. So be careful with the wheel strategy, apply it to things that work, take your time, be careful, and hit us up. Let's find out where your miscommunication is on the wheel, because when I'm reading that you're getting challenged and trying to not lose more than 50%, I'm thinking that your info on whatever taught you the wheel strategy was wrong, and that your application is miscommunicating something somewhere, right? Let's get you turned around and have you applying it in the proper way, because this strategy really takes care of itself unless you get an outlier move that just breaks the system and then you have to shut it down. Yes. Just ping them. On the screen, I've got Microsoft here, May 15th, and we got earnings coming up. It's April 29. I've got the May option here, and you can see it's a 37 implied vol, and it has a $34 expected move. And yet, if we go to June, which was the question, what about a June call for Microsoft? It has a lower IV, so the lower IV should be a lower expected move, but it has a greater expected move. So there's something wrong, and it's the April earnings. The earnings are messing with this, but there's the market doesn't know, right? This is telling you the market has no idea. And if the market can't figure it out, we can't figure it out. The war, the energy crisis, all of that is messing with the broader market. And this right here tells me that I don't want to do any sort of long call or long put trade unless I can do it cheap. This is a $1,500 call and this is a $1,900 call. I chose both expirations to show what if I buy a call 70 days out and Microsoft is in the same spot 30 days later. All that happened is I lost $400. That's all that happened. So, you're going to have to risk anywhere from $1,500 to $2,000 and sit on your hands and hope it all works. And hope is a really bad trade strategy. And you're going to have to hold it through earnings, which is terrifying as hell. So, can you buy that call? I mean, you could, but one, I would choose May, not April. That way you can avoid that earnings that we talked about. Uh, you're going to avoid it either way, right? You'll jump at either side. But I would avoid getting a long option in the Mag 7. They're green shoots that I covered the other day, right? This is Mags. This is a green shoot saying it's possible we could start getting along in the Mag 7. But you want to do that with cheap stuff, not $1,500 of risk. This is the weighted version, RSP versus SPY. It's going down. That also says growth versus values looking good. We could start to dabble in the Mag 7 space. And this is the IWF IWD, and it's turned up and it broke above $2. So those three things say green shoots, very small positions. You should be willing to take a minor amount of risk in long options in Apple, Microsoft, Google, Amazon, Tesla, Nvidia, but not it with my money, not $2,000 worth. Maybe, a tenth of that. Accounts are always so personal. So whatever you deem to be a low risk number that you could throw it on and walk away and not even look back. 2,000 is more than what I would deem throw it on and walk away and not look back. So yeah, no, I'm good. I did a while back, but I can't say that it got labeled when it was put into the replay. So I could go through it one afternoon, especially on one of those Fridays where we know we're not going to get a trade one of those days, and we could just go through all the charts. I know way back in the day, I did a video series called What We Watch and Why, but that was based on intraday trading and the various tools that are out there. And it was like a 4 hour video. Oh God, it was so long, but there was just so many things to cover. I think we could wrap this up in like one afternoon. I appreciate you guys. You make the live streams go quick. It's always engaging and fun. Later, everybody. Yep. Have a good weekend.